In March of 2000, the stock market made a peak that wouldn't be exceeded until 11 years later. The S&P 500 just over the next couple of years dropped by 50%. But in the few months leading up to this peak, investors got a very important warning signal that the US economy was weakening. This warning signal came from the transportation sector that declined significantly long before the stock market made its peak. In fact, we had a very similar occurrence in January of 1973, where the stock market made a peak that wouldn't be exceeded until 10 years later, with the S&P 500 dropping by 50% from that peak. But in the few months leading up to January of 1973, the transportation sector was again flashing a major warning signal. Today, history repeats as the stock market is soaring to new highs, but the transportation sector has been flashing the same warning signal that we saw in 2000 and 1973. This comes right as investors have stopped pricing in a recession as a potential scenario in 2024. Concerns around a recession peaked in late 2022, with the majority of analysts back then expecting that a recession would play out within the next year. Of course, these projections ended up being completely false, and now today these same analysts are saying that recession probabilities are much lower. Transportation stocks don't agree, and they happen to be a leading indicator of the economy. When the economy begins to slow down, less people are spending their money on goods, and so the companies that are responsible for the transportation of these goods are one of the first parts of the economy to take a hit. And today, with the transportation sector underperforming the S&P 500 by 15% just since the beginning of 2024, it's probably a good moment to ask the question whether markets today are sending the same signal that we witnessed in 2000 and 1974, before two of the most violent market crashes we've seen throughout history. Firstly, these were not the only signals from the transportation sector that we've seen. We also saw something quite similar in 1989. Transportation stocks were declining severely in 1989 and 1990, right before the stock market peaked and then dropped around 20% during the 1990 recession. So again, the transportation sector providing a clear signal that the US economy was weakening before the recession actually began. This is called Dow theory, and it suggests that when the stock market is making new all-time highs, like here in June of 1990, but that the transportation sector is not making new all-time highs, that the stock market is likely to reverse, which is exactly what happened back then. And it's the same situation that we have today. The stock market has been making new all-time highs throughout 2024, and yet the transportation average has been steadily moving lower. For us, this is yet another confirmation that we are indeed heading into a recession. Not that the probability of a recession is decreasing like analysts on Wall Street are suggesting. On the contrary, since about mid-2023, our belief is that the probability of a recession has been increasing substantially. However, Dow theory does not tell us exactly when the recession is going to occur. It just tells us that the economy is in the process of weakening. These divergences in 1970, in 1990, and in 2000 on average lasted around 280 days. The divergence we have today really began in December of 2023, which is around 160 days ago. If we are to follow the same path of these previous examples, it could mean that this divergence continues until September of this year. This is a timeline that we've talked about many times on this channel for the recession. But it's not just the transportation sector that's sending an interesting signal today. Companies that are sensitive to consumer spending have also been declining. This is a chart showing us the performance of consumer-sensitive stocks relative to the rest of the market, and these have been in free fall throughout 2024. Now, this doesn't have as good of a track record as the transportation sector, but we know that during real economic recoveries like in 2009 and 2021, which were both moments where the economy was coming out of a recession, we tend to see consumer-sensitive stocks outperform the rest of the market because the consumer during these periods is strong. An underperformance of consumer-sensitive stocks is something that we actually saw leading into both of these recessions as investors were sniffing that consumers were getting weaker. Again, that's definitely something that we are seeing today. So today's market is definitely a tough one to navigate. We still have the S&P 500 in a strong technical posture, so we want to be long on this market, but we don't want to be exposed to areas of the economy that are too sensitive to the business cycle like transportation or consumer stocks. Over the last couple of months, we've had trades like biotech, small caps, Indian, Chinese, and US technology stocks. All of these have been quite strong performers since the market bottomed in April. This is what we do at gameoftrades.net. We help our clients learn how to trade and invest properly, and most importantly, protect them from losing money. If you buy our annual membership, our service is really at a bargain price for the value that you're going to get. I might be biased, but I very much doubt that you'll regret it.